Hi friends, good evening. We will start the seminar in just a couple of minutes. Maybe we are waiting for a few more participants to join. Just allow us maybe a minute and then we will start the seminar. Okay, I think it's 4:03. Let's start the seminar. Good evening, friends. A warm welcome to all of you. I'm Nagesh. I head the retail sales at ASK Investment Managers. Today we have with us Bhavesh Kanani, who's the portfolio manager for our portfolio financial opportunities portfolio scheme. And I think indeed a day to have this seminar with the subject of financial opportunities, where financials or banks as in sector has been able to create a new high after April of 2022. Just to give you a small synopsis of Bhavesh's experience, Bhavesh has more than 2 decades of experience into the capital market, a decade with ASK Investment Managers, managing this portfolio along with his research expertise in the financial field. Bhavesh today will cover with us his outlook on on specifically the financial markets and also the latest earnings season which is gone by. We will have a view on those earning updates from him. More specifically, for questions related to the stocks, I would request participants to type in the chat box. As we have opportunities post the outlook from Bhavesh, we will be able to take these questions one-on-one. So over to you, Bhavesh.
Thank you, Nagesh, for the introduction. Let's first discuss what has transpired in the last earnings season. It was a fairly eventful earnings season as we saw some of the expected trends pan out. What are those trends? Let us take them up in the subsequent slides. So to begin with, on the growth front, robust growth trend continued for all our holdings. Just to highlight growth rate for some of these names within banking space. HDFC Bank looks, the growth looks weak at 11%, but that is due to the merger that happened with HDFC Limited. So we have adjusted the base as well. But other than that, if we look at all the other banks, they have performed very well and, comfortably above the PSU bank's growth. Within the NBFC space, vehicle finance as a segment itself continued to do pretty well. And within that, we have Sundaram Finance and Cholamandalam as part of our folio. And they too reported robust growth numbers for AUM. Bajaj Finance continued its 30 to 33% kind of AUM growth, which was fairly impressive. Within housing finance companies, while we don't own any of these names, just for sharing our understanding, housing finance companies consist of all the housing finance companies, that is affordable as well as urban focused large housing finance companies. As we can see, at overall level, housing finance companies' growth is just about 10%, but companies engaged in affordable housing finance have reported much better growth. This has been the trend in past and it continues. Within microfinance sector, we have credit access in the folio. Both the sector and the company continue to report very robust numbers. So these are about the company level. At industry level, essentially, we saw manufacturing sector loans growing by about 7%. This has been case for last many quarters, as we have seen large part of capex requirement being met by internal accruals rather than bank borrowings, and as a result, demand of credit from manufacturing sector has been in single digits. Compared to that, the services sector credit growth grew by 25%, retail by 30%, and agriculture by 17%. Here again, 30% includes impact of the HDFC Limited merger. It was an NBFC, and hence their loan book was not part of the banking system. Now that they have been acquired by HDFC Bank, their loan book is part of the banking system credit, and hence this 30% growth looks pretty high because of that effect. Within the manufacturing sector, as I was mentioning, large corporate credit growth continues to remain very low, largely because private capex is just about recovering and most of it is funded through internal accruals rather than borrowings. In terms of private versus PSUs, the growth gap between the two has increased a tad. As we can see here, private banks are able to report better growth. And we have already spoken about how the trends are for NBFCs. Second and most important trend that we have been talking about since last couple of interactions is the expected decline in NIMs, and that continues to pan out. So as you can see in this exhibit, Q3 of last year saw NIMs at their peak level, and then from there, gradually the NIMs have come down. This is on expected lines as lending rate hikes of banks as well as NBFCs have been halted because there are no repo rate hikes, whereas cost of fund continues to inch up as old deposits and borrowings reprice to higher rates. So we have seen NIM contraction for both banks as well as NBFCs. Some NBFCs have seen less of NIM contraction. For example, Bajaj Finance has not seen material NIM contraction, largely because of the fact that they have a fixed rate book and they tend to, the products they deal with, they tend to pass it on the higher cost of fund to eventual borrowers. That said, on year-on-year basis, so this NIM contraction we are talking about is on sequential basis. But if you compare, let's say, Q2 24 with Q2 23, the NIMs are higher higher or flattish in case of banks. So that's essentially the submission here, that NIMs are still marginally higher or flattish on year-on-year basis. And as a result, NII growth was pretty healthy. Other aspect, which is a key monitorable naturally, is asset quality. This is a trend of last entire decade, and we can see that asset quality has been improving right from 2018 for both private and PSU banks. However, large part of that improvement has ended in 23, and incrementally the asset quality improvement is there, but it is gradual. In percentage terms, public sector banks GNPAs are nearly about 2 times that of top private sector banks. Within NBFCs, we have seen that affordable housing finance companies' average GNPA has stabilized. Versus Q1, there is marginal improvement. Q1 tends to be impacted by monsoon-related challenges to the cash flow. That applies to affordable housing finance companies and to an extent to vehicle finance companies as well. And hence, compared to Q1, both for affordable as well as vehicle finance companies, we have seen improvement in asset quality numbers. Whereas in case of Bajaj Finance, the asset quality indicators have been flattish at healthy levels since last two odd quarters. One unusual trend that has been happening for last couple of quarters is related to how GSEC yield has moved. We have seen rates going down, which led to treasury gains last year, and now we are seeing little bit of treasury gains in the first half for banks because yields have kind of eased from where they were at its peak. And in Q2 also, we saw decent treasury gains. However, they were lower than Q1 at a aggregate level for top four PSUs. Similar was the trend for private sector banks, where there were healthy treasury gains, but they were lower than what it was in the previous quarter. From perspective of importance of treasury gains to the profit before tax, it remains a reasonably sized portion for PSU banks, whereas in case of private sector banks, the contribution of treasury gains is not so much high, which in our view is a positive thing. Overall, if you look at the sales, operating profit, and PAT growth after whatever trends we discussed, for the portfolio, we saw 27% sales growth. By sales, here we refer to net interest income plus non-interest income combined. And operating profits here represent pre-provisioning profit, which again grew by 27%. And little bit of lower provisions on year-on-year basis led to a healthy PAT growth. If you recall, in last couple of conversations, we have been mentioning that the gap between pre-provisioning profit growth and PAT growth, which was very high in last 2-3 quarters, was expected to converge, and that gap has come down on expected lines. Incrementally too, we are likely to see this gap converge, primarily because provisions, as we saw, asset quality trends are stabilizing. So provisioning requirements, which was coming down on year-on-year basis, will kind of stabilize too with time. And that essentially will mean that operating profit growth and profit growth will look more and more similar incrementally. In terms of macro setup, if we look at the capex intensity level, it is sustained. As we have seen, steel and cement consumption remaining pretty healthy in 7 to 8% range. Consumption demand, however, was a little muted, and managements essentially have guided for better demand in second half or so. And in all this setup, we saw global slowdown continue to impact the export growth at economy level. Chinese exports have accentuated the impact on export volumes in first half at least, and it is expected that in the second half or in Q4 onwards, this pressure should ease and India's export outlook should improve. Lower input cost aiding to margin expansion for most of the end user industries and should reflect in better profitability as we move ahead. Incrementally, what we have to see is the agriculture trends and how it impacts the rural cash flow and the geopolitical situation. Election calendar, we have already handled that last week with the ruling government reporting a very good show by winning in all the key states. In terms of specific aspects that impact banking sector, as we discussed, the demand for steel and consumption sector remaining strong implies that capex demand is healthy. As we discussed, large part of this capex is being met by internal accruals, but with time, corporates will begin leveraging, and that will mean improvement in large ticket corporate credit demand as we go ahead for banking sector. Now, patchy monsoon is expected to translate into some impact on agriculture output, and as a result, the consumer staple growth, which is essentially related to your rural cash flows, continues to remain muted and likely to remain so going forward for a couple of quarters. This has implications for microfinance companies, vehicle finance companies, affordable housing finance companies, and other rural segments. Currently, the demand for vehicles, MFI loans, and affordable housing finance companies continue to remain healthy, but just out of conservatism, we'll keep all these sectors on a close watch, given what is happening on the agriculture output side. The Q2 GDP reading was pretty impressive at 7.6%. Our RBI governor had already warned us about a positive surprise, and the economy has delivered one. Now, this has been supported by front loading of capital expenditure by government. Private capex, it appears, other than the economy level challenges or risk that a corporate would like to consider, election could have been a major consideration, as corporates would like to see election season getting over. They would get better clarity on the government policies for next 5 odd years, which would allow them for better clarity on how to plan their capex and how to grow their business. So that seems to be happening at this stage, and probably after the union elections are over, we may see private capex actually picking up. On food inflation side, food inflation sustains at higher level, although CPI, that is overall inflation rate, has come down a little. This has implications for policy rates, because we are looking at a very healthy GDP growth and food inflation sustaining high. That may force RBI to act on the policy rate front. Although food inflation is something which is not too sensitive, or it does not respond too quickly to policy rate hike, because it is mostly to do with supply side challenges. And lastly, we expect economic activity to remain healthy. We have had a fairly good festive season, and as we get more and more clarity about the union election outcomes, gradual economic pickup in activity, capex activity, would continue to remain healthy. That is all I had to share from my end. Now we can take up questions.
Yeah, Bhavesh, thank you very much. I'll request participants to type their questions in the Q&A box, and we'll be asking those questions with Bhavesh. Bhavesh, till the time we get questions from the team, maybe I have a question to check, and I've been eager to ask this question for some time now. With today's rally that we saw, maybe for a brief of around 3.5% in the banking sector specifically today, post the election results which have happened, okay, Why do you feel this has happened? Is this because, banking as a sector has been a sector which has not done well for maybe some time now, and that's the catch up which has happened? Or we are now seeing FIs coming back in the market after this kind of a thumping majority which the ruling government has gotten at this point in time? What is your view on this particular aspect?
See, it's too early to say if FI flows are back, but one thing is certain that people were looking for clarity on who is going to rule for next 5 years. Naturally, one would look at the three state elections as a semi-final, and final is yet to happen. But directionally, it provides comfort that the ruling government is likely to continue to remain in power, and hence the policies which we have seen for last decade of this ruling government's regime will continue for another 5 years at least. That gives positivity because this government has put a lot of things in motion, whether it is capex on roads, whether it is energy, whether it is railways. So all those capex plans and the kind of infrastructure investment government has earmarked, all that is expected to trickle down into better growth opportunity for a lot of sectors, and that probably got reflected in the positivity we saw in markets today. So that essentially is what is impacting the broader markets. For banks in particular, I would say valuations were always reasonable uh, in context of the return on equity they are delivering as well as historical context. So there was always a room to go up. Part of it has happened, and naturally there is more to come.
Yeah, a connecting question to that, Bhavesh, relates to a question which Sanchit has asked. Given that US Fed has taken a stance of not reducing interest rate, do you think there will be a material impact of foreign flows on banking stocks currently, or how do you read that part?
This is a if I had answer to this question, a clear answer, I would be a billionaire. Jokes apart, it is a very important factor. I agree. Forecasting it is difficult, but see, as far as the U.S. Fed rates remain high, the equation for money lying there between debt and equity, between emerging and developed, remains unfavorable to us. Because if the GSEC there is 5%, a lot of money holders there would take a call that it's better to remain invested in debt market of US rather than risking that money in India. So that is what plays a lot on their minds, uh, and the effect of which we have seen. FIs typically tend to invest heavily in three sectors: consumer, IT, and finance. And all these three sectors have been impacted by the virtue of the fact that FI flows have not been there. So how long this will continue, there is no way of knowing. I wish I had some crystal ball to gaze in and get that answer.
Sure. Point taken. Coming back to India specifically, couple of weeks back, we saw RBI tightening some nuts on personal loan and unsecured loan. Okay, and the risks that have been highlighted by RBI. How do you read this particular situation, Bhavesh, in this particular space, and how will it impact to our portfolio specifically in that space? Is there something that we can look at positively also in this particular part which has happened recently?
Yeah, so there are two parts to this entire situation. One is RBI has been talking about rising risk in unsecured loans since quite some time. Whenever there was policy announcement in the meetings and conversations, they would hint towards containing the unsecured loans growth in the banking system. Now, if we look at the data at bureau level, one realizes that yes, there was increasing delinquency in personal loans and unsecured loans. However, large part of this pain was coming from very small ticket personal loans, that is below 10,000 ticket size. Typically, banks and NBFCs that we have invested in, they don't engage in this kind of small ticket lending. So what essentially happens is we are talking about borrowers where they were already running 2, 3 loans. Since there are fintechs willing to give loan, fourth loan or fifth loan of even 10,000 rupees, some borrowers end up taking those loans because of cash crunch or whatever. Because of this, what happens is, let's say the first 3 loans were given by a bank or NBFC, and fourth loan of 10,000 was given by this fintech. This pushes the leverage of the individual borrower higher, and in event of challenges on cash flow, the borrower may face more severe financial difficulties and create problem for even for banks and NBFCs to an extent. However, large part of these loans, as I said, are housed with fintechs, less than 10 or 15,000 ticket size. Portfolio of large banks is behaving pretty normally. We have had conversations with all the leading banks and NBFCs. There is no untoward movement there. But it's a step by RBI at right time, because RBI has to think of entire system level rather than large private sector banks or large NBFCs. And from their perspective, by raising risk weights, they are essentially discouraging entities away from this unsecured personal loan segment. For our pool of portfolio, the impact is marginal. For our set of banks and NBFCs, within that, Bajaj Finance is one who is more active on the personal loan side in terms of composition of the loan book. All the banks have personal loan portfolio, but given their large balance sheet size, the proportion is smaller.
Participants, please type your questions. In the meanwhile, let me pose one more question to Bhavesh. Bhavesh, we've been hearing every day in the media or everywhere that asset quality is improving. Asset quality continues to improve. Asset quality will go up or improve by another 3% by 2024 March, so on and so forth. Do we still have that scope left that asset qualities will improve, and are these specifically diverted towards PSUs? What are we talking over here, and how long will this particular journey of asset quality improvement will continue in this particular part which we are talking about? Because this is something which we have been hearing every day. Any views on this particular part?
Yeah, I mean, as we discussed in one of the slides, asset quality has been improving, but as we get into every next quarter, the pace of improvement is slowing down, largely because this entire improving trend in asset quality was because of the fact that whatever pain we saw because of COVID, that gradually got resolved. Cash flow of borrowers normalized as business activity normalized, and they started paying off the past dues. And so GNPA number continued to come down. Large part of that improvement, in my view, is over, and which is why we said that incrementally asset quality will not improve dramatically. It will stabilize, depending on which bank you are talking about, which product a particular lender is dealing in. And in line, the provisions too will not come down further dramatically. And as a result, we will see operating profit and bottom line growth mirroring each other. They will be very closer to each other as we go forward. This has been our call for last many quarters, and that is what is happening. If you talk about Q1, probably NII growth was around 13, 14%, 15%. But bottom line growth was like 30% or 35% for a couple of quarters. Now the gap between these two has kind of narrowed down, and that will continue to be the case in quarters to come.
Got it. Maybe let me move more specific to the portfolio stocks which are there. Now, one question which might have got posted to you a couple of times or many times, specifically to HDFC Bank. Okay, post the merger, the weight in our portfolio now stands at around 14% with the combined entity. Now, 14% of the portfolio before today's movement of 3.5% that we saw in one day in HDFC Bank. HDFC Bank in last 1 year is given 0% return. And maybe if I extend it to 2 years period where we have seen a negative 2.5% compounded returns into HDFC Bank. With this kind of a weight which is there into the portfolio, does it still have the legs to cover up? This is what is the general feedback which has been coming in. So just wanted your views on this particular stock.
Your perspective will change as soon as I mention that while in our folio the weight is 14% odd, in the benchmark BSE Finance the weight is 30% plus. So we are actually significantly underweight. Now coming to fundamentals, large part of this poor performance has been due to the fact that the entities were getting merged. It is not a small merger. It involves one bank and one NBFC. It is not a situation where both are banks and merger is easy. Both were fairly large companies with huge balance sheets, so it has its own merger integration challenges. In terms of fundamentals, because of this merger and the fact that HDFC Bank would have to take over borrowings and loans of HDFC Limited, HDFC Bank had created extra liquidity for merger purpose. That is to the tune of 1 trillion rupees. Now this 1 trillion rupees has been parked in liquid assets, and naturally it is not yielding yields of the order a loan book would yield. And as a result, we saw first quarter result post merger witnessing NIMs coming down. Over time, next 3-4 quarters, what we expect to happen is HDFC Bank should be able to bring down this liquidity as large part of the borrowings of HDFC Limited are replaced by HDFC Bank's deposits. It is precisely for this reason that HDFC Bank has been growing its branch network very aggressively. In last 2 years, they would have added some 3,000 odd branches. And all these 3,000 branches naturally would go out and garner deposits of all kinds, CASA as well as term deposits. This is what is going to allow HDFC Bank to bring down the LCR ratio. Essentially, the 1 trillion worth of liquidity will normalize, which will allow for NIM to improve. The implementation of this deposit strategy, as the effect of this is seen in numbers, probably we'll see better performance from HDFC Bank.
So what do you expect going forward in HDFC Bank to continue with their growth? But what is your expectation in terms of their delivery? We will see better numbers. But what if you have to put a number to it, how would you put this for HDFC Bank?
As in you are talking about bottom line growth perspective?
Yes, for the bottom line growth.
So currently we are looking at ROE at around 14.5-15% for this year.
Wow.
This compares with 17% kind of ROE HDFC Bank used to deliver on standalone basis. So this year, naturally, this 14.5-15% ROE has this impact of excess liquidity and a lot of one-time adjustments related to the merger. As we move ahead, we expect that over a 3-year journey, this 15 odd percent ROE should gradually expand and normalize to 16.5, 17% ROE. That is our expectation.
Sure. I think good days to come for HDFC Bank.
Yeah, hopefully for the entire sector.
Bhavesh, one thing which we have noticed in the portfolio now is there have been a couple of new stocks, I would say, sectors in a specific way that we are looking. So within the sector, we have seen a rating agency making a cut into the portfolio now. We have seen a microfinance company which is there into the portfolio. So the rating agency being CRISIL, which has been there into the portfolio, and microfinance in the name of this Credit Access Grameen Bank. Suddenly we are seeing a lot of changes which is happening from our traditional way of looking at just banks and NBFCs, while all these have made a cut, including MCX.
Yeah.
Why have we made these changes into the portfolio in this particular space? And what's the outlook on each of these names that we spoke about? Maybe in brief, if you can just give us a quick snap on all these stocks which we just named.
Sure. So in general, the desire is to increase the non-lending composition in the portfolio. That is where CRISIL and MCX come into the picture. Essentially, large part of our portfolio, banks and NBFCs, all are taking credit risk and linked with loan growth. So to balance out that risk in a situation where asset quality improvement is largely over, we thought we'll increase the contribution of non-lending financials to add more stability to the portfolio. On individual case, let's say we'll first take up the MFI space. We already discussed about the growth rate the sector is churning, especially just after COVID, the MFI sector had undergone a lot of challenges because there were a lot of NPAs. The growth had come down because companies were busy resolving NPAs and they did not want to lend incrementally until cash flows normalize. And so they have spent 1.5, 2 years doing that exercise. And once we got the confidence that balance sheets are clean, demand is coming back, and we are good for next couple of years in terms of growth as well as asset quality. We search for a right kind of name, and Credit Access, is what we narrowed down on because of their track record historically over past crises, both demonetization as well as COVID. The way they have handled it, the way book has remained robust in all this crisis, as well as the fact that they are pretty strict when it comes to NPA recognition, and they typically want to maintain a 0% NPA. So these are some of the basic things which sets Credit Access apart. Of course, there are a lot of granularities, but for discussion, these are some of the key things that sets it apart. On MCX, while we like the business of commodity derivatives and the kind of volumes they were churning, especially on the option side, but they were undergoing a transition of their core tech platform, and there were a couple of challenges in the transition. As we gain clarity that large part of the tech transition problems are over, and they will eventually be able to successfully move to new platform, that is when we decided to enter, and we have been able to make reasonably good gains there. On CRISIL, it is essentially a mix of two opportunities. One is the domestic rating business, and another is research related businesses. Domestic rating, as the name suggests, is more inward looking, is connected with the India opportunity, as large corporates go for bond issuances and all. They tend to take services of rating agencies, which is where CRISIL comes in. They have the largest share. and the rating, methodology and quality is respected the most. So one that domestic part is in a way connected to the private capex rating domestically. The research business is more connected with the banking system of Europe and US, where CRISIL is offering a lot of services to these large players and is adding to capabilities through S&P, the parent, which gave us confidence that it can continue to churn a very reasonable growth for next 5 odd years without any real risk. End of the day, all these are services. There is no money to be lent or any balance sheet risk as such, and that is what led us to buying CRISIL. I think I've covered all of them now.
Yeah, one more stock which we have seen Chola, which has been there in our portfolio for long in various portfolios at ASK. Now we are seeing Sundaram Finance also, which has made an entry in this particular portfolio.
Yeah.
Any specific reason that we are also looking at Sundaram Finance now in this particular aspect?
Sure. One is the vehicle finance sector itself has been doing pretty well. Within vehicle finance, if you look at last 20-30 year odd journey, we realized that at one point Sundaram Finance was the first name that comes to mind when we talk about commercial vehicle finance. But with time, Chola Mandalam took over and created a bigger name for themselves by financing all kinds of vehicle and not limiting themselves to only commercial vehicles. That is, they used to finance your small CVs, tractors, used commercial vehicles, construction equipment, and so on and so forth, which Sundaram did not do for many years. Gradually, now they have been working more and more to also diversify their transport finance business by getting into different vehicle types. They have been fairly successful in LCV, that is light commercial vehicles and tractors. They are deepening their presence more and more in areas like used CVs, as well as they have diversified into non-transport segments like SME and housing portfolio as well. So this diversification is what appealed to us. And second, Sundaram has still a long runway to go in growing its vehicle finance book itself. Just to highlight, Sundaram Finance does not have a single branch in Uttar Pradesh. It's a fairly large state for any vehicle finance company. So this idea was to highlight that geographically also Sundaram has a lot of opportunity to explore. Over and above diversifying product in existing southern states where it has fair bit of dominance. That is the reason why we got into this.
Yeah, I think even you touched upon MTX, which moved on to a new platform in November. So that's something which should help to give legs for MCX to grow further. Yeah.
Yes, certainly.
Okay. Now, one question which we specifically got right now from Mangesh is, if you look at last 5 years, while we have seen Nifty TRI maybe delivering around 13%, whereas if you talk specifically on FOP, we have underperformed the Nifty TRI maybe couple of percentage points, specifically being 3.5% to what it has been delivered. Any specific reasons that you're looking, while you touched upon what we are looking and how the portfolio has been there, but this is more to do with why this underperformance has happened. And second, I think on the outlook, which what we are looking at this particular portfolio.
Okay. So, couple of reasons. One is, if you look at last 2.5, 3 odd years, we'll realize that our stance, ASK as a house and FOP as a product, has been to always focus on quality names, and which is what you have found all across our portfolios, even if you go 10 years back. In last 2.5, 3 years after the quality had performed, we saw a phase, long enough phase, where, rather than quality, value is what was working. And by value in BFSI sector, that would mean PSU banks, that would mean, a lot of state-owned NBFCs, and those kind of entities. Now, it's not that we have specific allergy to PSU banks, but when we try and enter businesses, we are looking at 5 year plus kind of period. We are looking at sustainability of superior return ratios. And that confidence in PSU banks was not there. We did buy State Bank of India because within PSU Pack, there are only handful of PSU banks which are actually trying to change their culture and the way they function. And that is why we entered in select name. Incrementally, what we should expect from this fund is at aggregate level, the earnings growth for this fund should be around 16-17% for next 3 odd years. There could be some years when, because of the way interest rate cycle is, the earnings can be a little weaker. But over 3 years, we should expect 16-17% kind of growth. And in line, more or less similar should be the kind of returns we should be able to generate. If we talk about past, that is before COVID, over many years, we have seen that earnings growth eventually translates into similar kind of price growth. This connection or this relation got distorted in last couple of years because of various reasons. But over longer period of time, this is our faith remains that the earnings growth will reflect in price growth, and in line we should expect 15-16% kind of returns from this portfolio.
Yeah, I hope Mangeshji, your question has been answered by Bhavesh. Bhavesh, moving on, let me ask you a question relating to a sector specific. We have seen insurance sector maybe couple of months back. It may not be up to the mark in terms of what we were expecting, but suddenly we have seen insurance sector, whether we are talking about general or life, suddenly starting to make good returns overall. Why this is happening, first of all? And second, do we feel this will continue for some time? Yes, we have been talking about insurance years back, thinking that insurance will do well, but we have seen action now in this particular space. Any specific outlook that you have for this particular sector going forward?
So, see, for insurance, the reason why they had hit an air pocket just around after the budget time was because of the fact that government decided to pull back on some of the tax benefits on some of the products. And those were fast selling products, high ticket products. And given the absence of tax benefits, there was a perception that the premium growth will come down dramatically for private insurance companies who were dominant in selling these non-par guaranteed return products. With time and as monthly data came in, people realized that is not the case. Now, around the budget time, we just after this announcement, we had a chance to speak with the life insurance companies that we own. And one thing that came out clearly in the conversation was that tax saving, probably a decade back, was one of the key reasons behind buying insurance. But with time, tax saving is probably sixth or seventh purpose in order of objectives behind a person buying an insurance company, insurance product. So in terms of priority, that is one. Two, eventually we have to assume that all the tax benefits or exemptions for life insurance products will go away. So life insurance products have to stand on their own feet and compete with alternatives. And life insurance products actually do solve problems which are not solved by any other product. Let's say this non-par guaranteed return savings product itself, it is pitched against fixed deposit at times. But fixed deposit, if you try and create a longest term, you will get probably a 5-year fixed deposit. Whereas these non-par products give you much longer surety of returns in terms of tenor. It can be 7-year, 10-year. So just like that, all the insurance products of other nature, they are solving very important needs of customers, and they will continue to remain relevant. As far as overall saving story is concerned, in my humble opinion, it's a very long journey for savings industry. A large part of Indian households today are busy consuming and buying assets. Once their disposable income reaches a certain threshold, they'll start saving more and more. So the runway for mutual fund industry or life insurance industry is pretty long. That's how I'll put it.
So great future for insurance in the coming days.
Yes, certainly.
But we haven't looked at asset management business in our portfolio. While we had some, but not now into our portfolio. Insurance is one part of the story. Any specific reason towards it?
So one is the growth challenges, then yield challenges. We saw 2023 and 22 profits growing practically nowhere for AMCs because yields were coming down. Despite the fact that share of equity in their overall AUM actually improved. So there is part of AUM at industry level which was getting churned. That AUM was old, on which distributors were not earning any commission. And because of churning, the AMCs were forced to pay them commissions on the same AUM on which they were not paying commission earlier because of upfront and tail transition. So that was a transitionary impact. That was followed by the regulatory challenges from SEBI, wherein they decided to do a lot of changes to the TER. The proposed changes were naturally onerous, and there was representation from the industry side, following which SEBI chairman decided to put those proposed changes on hold, and they have requested feedback from industry, and post which they'll assimilate all the feedback and come out with revised set of regulations. So there is a little bit of uncertainty on the TER side. That is what is keeping us a little cautious. That is on standalone side, and naturally, one has to pick and choose between various business models within BFSI. AMCs may be doing well, but it is one side of the saving story. What if other better alternatives are available within the savings embed itself? So that's another factor that comes into play.
Sure. Participants, if you have any further questions, please type it. I am completed my set of questions which were posted. Any specific question anybody wants to check? Bhavesh, let's give a minute for participants to type.
Sure.
In the meanwhile, maybe till the time participants type, one more question which came into my mind was, you spoke about these treasury gains being lower.
Yeah.
What is the reason for that particular thing to happen specifically for banks? Any specific reason?
So treasury gains are essentially capital gains that banks book on their treasury book. And treasury gains are inversely related to bond yields. When yields come down, bond prices go up, and banks are able to book capital gains. I'll just share a screen, probably that will make this thing clearer. Is the screen visible to everyone?
Yeah, it's visible.
Yeah. So now if I look at 6 months period, this is India 3-year GSEC yield. So what is needed for treasury gains is yields going down. Whereas what has happened from, let's say, June end is here, to September end, the yields continue to go up. And it was practically one-sided. You know, if it was choppy, people would have traded and made some gains, but it was more or less one-sided, because of which treasury gains came down in Q2. After the September quarter, we have seen yields going up further, but they also came down end to end. They are sideways. This volatility would allow traders to make money. If we look at last 1 year horizon, we'll realize that this period, that is September last year starting to almost May 2023, during this period from March to May, the yields were coming down, and hence banks had reported pretty healthy treasury gains. So essentially, it is to do with how your yields are moving, whether they are volatile, they are one-sided, they are going up, or they are going down, which allows, and banks have to carry a lot of liquidity, and which is typically getting parked in GSECs, because they have to maintain statutory liquidity ratio, which is part of the risk management that RBI has put in place, that, to meet the withdrawal requirements of all the borrowers, banks are supposed to maintain certain minimum amount of liquidity in GSECs.
Right. I think, Bhavesh, there are no further questions which are coming from the participants. I think let's wind up this call. Thank you very much for your time and your insights on this particular sector and the stocks that we discussed. We will catch up again, friends, next quarter with Bhavesh on update of this particular portfolio. Bhavesh, any final comments that you want to make, and we'll wind up this call?
No, just that thank you for the faith you have shown. We'll try our best to make changes which generates those returns which is expected by the investors. If there are any other areas you would want to cover in future interactions, you may let us know that. The idea is to meet your expectations or share the insights that you want. So all the feedback is welcome, and best of luck.
Thank you, Bhavesh. Thank you. Thank you, participants. With this, we end the call. Thank you.